Hello, I'm Kim Stafford, and I'm here again with PIMCO Group CIO Dan Iveson to give you an inside look at some of the recent discussions taking place within PIMCO's Investment Committee, or IC. Thank you for joining us, Dan.
Thanks, Kim.
Many investors have been surprised about the decline in yields over recent period. So can you discuss why yields have been falling and if bond markets are trying to signal any important trends to investors, particularly in light of the fact that we've seen equities reach new highs?
Sure, and it's of course always tough to know for sure what's driving moves in interest rates, but let me bucket them in two categories. The first being technical. We still are in a world where there's very little yield. So, this is a market environment or a trading environment that feels like people want to add duration or interest rate exposure. Of course, there are some legitimate concerns around inflation, but in general, a lot of pent-up demand for interest rate exposure, and we think that is helping support yields, even driving yields lower. But from a fundamental perspective, looking at economic data carefully over the course of the last couple of months, there have been signs that we have reached peak growth, that a lot of the impact of stimulus that occurred last year is beginning to dissipate, that these COVID variants, led by Delta, of course, is leading to some growth pressure or reopening pressure that we're seeing across the economy here in this country, but in other regions around the globe, particularly emerging markets as well. And that has, we think, caused the market to reduce their growth assumptions somewhat.
You mentioned low yields. You mentioned the search for returns. So we've definitely seen an uptick in interest in alternative investments, particularly for clients who can give up liquidity. So how are you thinking about investing across public and private markets? And how do you assess which strategies may or may not be appropriate for different investors?
Clients are looking to be creative to maintain returns they've grown to expect, or given pretty full valuations, looking for resiliency and protection where they can find it. And one way to achieve that, of course, is to be more flexible in terms of the mandates that you focus on. That may mean giving up liquidity. It may mean straying away from what is typically in a more traditional fixed income or equity benchmark type product. And that, of course, is what PIMCO is trying to assist our investors with, be solutions providers, look to create flexible mandates when a client can afford to give up some liquidity. And in the current environment, with central bank support being so impactful to more traditional areas of the market, we think it makes perfect sense to look for that flexibility. And that sometimes means tapping into opportunities on the private side of the opportunity set, but certainly expanding the mandate, being more flexible, sometimes working in a very non-traditional way as true partners in various types of strategic mandates as well. And I think by doing that, you can pick up meaningful incremental return, incremental yield. If you're talking about the fixed income opportunity set, the relative attractiveness of some of these more off-the-run sectors remains quite wide from a historical perspective.
And any examples of alternatives that you're seeing that you find opportunity today?
Sure. Looking at the commercial real estate markets, the CMBS, more traditional segment of the public opportunity set, have seen spreads compress significantly across the capital structure. AAA risk, but also lower rated risk, even higher yielding segments of a typical CMBS capital structure have become a bit expensive, again, from a historical perspective. You look at the same or similar risk over in parts of the private opportunity set, and there continues to be significant value. Similar example in the corporate credit space. In the more liquid segments of the market, certain COVID recovery themes and trades we continue to find attractive. Gaming, hospitality, the leisure sectors as examples of segments of the market that we expect to continue to perform. But when you cross over to the private opportunity set, similar themes, the ability to invest with more direct control, potentially better protective covenants, and an expanded opportunity set.
You mentioned commercial real estate, and maybe we'll delve a little deeper there. An area that straddles both public and private markets, one that has had a little bit of upheaval during the pandemic. So maybe specific opportunities in commercial real estate from your perspective.
Absolutely right. There's the opportunity to potentially generate returns by targeting areas of the market that were most significantly hit by the COVID situation, the lodging sector as an example. But there's also ways to invest with a more resilient profile, segments of the higher quality areas of the office space as an example. Then finally, from a very top-down perspective, although we're early in the recovery process, from a valuation perspective, things feel late cycle. There's a lot of debt out there in the world, a lot of debt within the more traditional corporate credit markets. And because of this demand for yield globally, you don't get the same type of protective covenants. So it's nice late in the cycle to have an investment that's backed by a real building, backed by a hard asset. In the commercial real estate opportunity set, even commercial mortgage-backed securities are an example of a profile that typically is more resilient than unsecured corporate debt alternatives. Not alone, we still like asset-backed investments, housing-related investments, particularly seasoned investments that don't rely on home prices to continue to increase, but have benefited from the significant increases we've seen in the last year or two. We think those are good later cycle investments from a valuation perspective.
So where else, where PIMCO is seeing, what are other high conviction ideas right now? And importantly, where are we avoiding in markets?
Sure, so we're a bit more defensive on interest rate exposure here. We're fairly constructive, at least in the base case, that inflation will remain relatively under control and will revert back to levels that central banks are comfortable with. You're just not getting paid a lot to take significant inflation risk across portfolios. High-quality segments of the bond market look a little expensive to us. Also, more generic areas of the corporate credit markets, we think, look a lot less interesting to us. Then finally, there are areas of the emerging markets that we think make sense to diversify portfolio exposure, generate some incremental returns, but you have to be incredibly selective down at the country level, and then even within a country, determining what the best way to express views are, whether it's external debt, local rates, currency.
Well, thanks very much, Dan. And thanks to all of you for joining us. We'll see you next time.